Hi, Cam. In our last video, we reviewed your long-standing research on the shape of the yield curve and its macroeconomic implications. Can you provide a brief overview for our viewers?
Sure. The idea, I think, is very intuitive, and it's basically the idea that a longer-term interest rate, the level of that rate is higher than a shorter-term interest rate usually. So think of like a certificate of deposit at the bank. If you lock your money for 5 years, you get a much better rate than, let's say, locking for 3 months or a year. So the idea is that normally these longer-term interest rates have a higher yield than the shorter-term interest rates, but that's not always the case. So in certain rare situations, we get an inversion, which means that the shorter-term interest rate is higher than the longer-term interest rate. And you can think about the sort of reasons why that might occur. It's rare, and often people are piling into these longer-term bonds like the 10-year US Treasury, the safest bond in the world. And in doing that, it drives up the price, drives down the yield, and then you get this weird situation where the yield curve, and that refers to these interest rates of different maturity, is inverted. It turns out that in my dissertation in 1986, I found that these inversions had a very particular pattern in the business cycle. Indeed, they preceded recessions. So that's why this yield curve, I think, is getting a lot of attention today. It is a harbinger of bad times to come.
And so a few weeks ago now, we saw the 10-year yield dip slightly below the 3-month yield. What do you think this foretells for the economy, or are we still in a wait-and-see mode?
So the last time that the 10-year yield was below the 3-month was in July 2007. And you know what happened after that? So again, this is a rare situation that happens before recessions. So it's definitely important that investors take this very seriously. That said, in my dissertation, it required that this inversion be sustained at least over a full quarter. So just inverting for a couple of days or a week, that's just not good enough. And the logic for the quarter is that GDP is what we're trying to forecast, and GDP is measured over a quarter. It's not measured over a day. Nevertheless, any inversion is got to be bad news.
So as you mentioned earlier, the yield curve is getting a lot of press these days. Not so the case in the 1980s when you were doing your dissertation. Do you think this could just be a self-fulfilling prophecy?
Yeah, so that's a very insightful question. And you're correct that after my dissertation, nobody paid attention to me. I got a little attention after the crash of 1987, when the consensus amongst economists was there would be a recession in 1988. But my model said 4% growth, which was way different than the consensus. And it turned out the growth was over 4%. So one thing about this yield curve is that it just doesn't predict the recessions. It doesn't have the false signals, at least over the time that we've measured it in the last 60 years. So the recession of 1990-91, that was forecast correctly. The recession of 2001, that was forecast correctly. The global financial crisis forecast correctly. So I guess the thing is that when you put that all together, the increased publicity that it's gotten, it is possible that because people expect this indicator to perform, it could actually be a self-fulfilling prophecy. But I want to walk back a little bit on this, because really what we're doing is giving investors a tool to better forecast real GDP growth. So they look at that tool, it's got a good track record, and they're more prepared for a recession. Consumers also. So when the yield curve inverts, it's not the time to borrow some money to take a vacation to Orlando. This is the time to save, to have that cushion ready. So in a different way, if I could turn the question a little bit, maybe what this does is it allows people to take some measures that indeed could slow the economy, but also to protect consumers and investors and maximize the chance that this is a soft landing recession. It's not a global financial crisis, it is a soft landing recession, and we can deal with that. We know the business cycle is not going to go away. There will be some high growth phases, there'll be some low growth phases, but if those low growth phases are soft, then I think it's better for the economy as a whole.
So from an investor perspective, taking this macroeconomic discussion down to the actual investor level, it sounds like investors should be slightly more defensive, a little more risk-off posturing. Any other advice you would give to investors or our viewers?
Yeah, so one crucial piece of advice is that there are many indicators that are forward-looking, and the stock market is traditionally a forward-looking indicator, but it's notoriously unreliable in forecasting recessions. So people might see, oh, well, the stock market's doing well, but the yield curve is inverted. You need to look at the track record, and you can't be fooled by what's going on in the stock market because it is way more complex than a bond yield on a government treasury. It's way more complex. It will deliver much more noise. So that's one thing, that don't be fooled just because the stock market's going up. Indeed, if there's anything that investors should do, it is to look at their portfolio to see the sort of valuations of the either factors or stocks that they're actually invested in. This is a very long period that we've had a bull market. And that bull market coincides with the end of the global financial crisis. And we are at 119 months right now since the last trough. The average length of a business cycle is 58 months. So we're more than double. So this is exactly the time to take some risk off and to be prepared for a downturn that could occur within the next year or a year and a half.
Great. So to summarize, the yield curve is inverted. The 3-month yield is now above the 10-year, but it's only over a few weeks. Your research says we should wait at least a quarter before making any real inferences from that. So from an investor perspective, take some risk off, be a little more defensive postured, but also understand that there are a lot of other indicators out there.
That's exactly right. So my research showed that there's a link between the slope of the yield curve. So that inversion is bad news. My model is a very simple model. It's got one variable, and the world is more complex than one variable. So I already mentioned that the stock market is a very noisy indicator, a lot of false signals. Nevertheless, it is important to look at the stock market as another indicator. There's many other things that investors should look at that are leading indicators of the business cycle. For example, Duke University does this survey of CFOs. We've been doing it for 25 years. These CFOs, they know the CapEx plan for the next year. They know the employment plans. So they are exactly the people you should be listening to. What are their firms going to be doing over the next year? So very important information. So there is a myriad of information that needs to be taken into account. That said, there's this one indicator that's got a really good track record. Yes, I'm a bit conflicted in terms of I'm the one that published the dissertation, but the record of this indicator after a publication of my dissertation should be looked at very carefully.
Great. That's very helpful information, and I'm sure our viewers will take a lot of information from it. Thanks, Cam.
Okay, thank you.